In addition to stock options and restricted stock awards or units, companies can also give different type of stock compensations. Employee stock purchase plans is one of them. So usually these type of plans are given to all employees, and employees can purchase stock at a discounted price for a short period of time. So to calculate the value of those type of stock options or the compensation expense is very complicated. So the companies can avoid recording or recognizing this type of compensation expense if it satisfies all these three conditions. Number one, that it should be given to all full-time employees on an equitable basis. It's not like the stock options or other restricted stock awards or restricted stock units that are usually given to specific employees to retain them, or top level executives such as CEOs or CFOs. So this type of employee stock purchase plan, which is to buy a stock at a discounted price, this should be given to all employees on equitable basis, and the discount should be very low compared to the market price. Usually it's 5% or less than 5% discounted price that employees could purchase the stock, and the plan should not offer any other option features. Now we will see one example. Public supermarkets stock purchase plan allowed all employees to purchase his stock at 5% reduction from the market price and for a short period of time. Now, whether this company should record it as a compensation expense. Now, if you look at that, it fulfills all three conditions. It is given to all employees, and it is only for short time period that employees can purchase the stocks at 5% discounted price. So since it fulfills all conditions, public supermarkets does not need to record this compensation expense. Now, if you look at the recent trends in stock compensation plans, you will see that nowadays companies are not granting stock options. Rather, they are more granting restricted stock hours or restricted stock units. Why? Because if you give stock options to employees, you will see that it's not guaranteed that employees will exercise the options, and there is no guarantee that stock price will go up compared to the option price. So on the other hand, restricted stock hours or units, it does not become completely worthless. And if you give stock options, usually the value per option is very low, and usually the companies give stock options a huge number. For example, 100,000 shares stock options. So if all are exercised, the total number of shares outstanding will be huge. For options, it's more likely to have more dilution. On the other hand, for restricted stock hours or units, the total number of stocks that will be issued or will be given are usually lower, way lower than the number of the stocks that might be recorded due to stock option exercises. So restricted stock generally results in less dilutive in existing stockholders. And again, restricted stock better aligns with employees' incentives with the company's incentives, because here they are receiving directly the stocks rather than the option to purchase the stock at a certain price. So nowadays companies are giving more restricted stock hours or units rather than stock options. Now, how companies will disclose those? So of course companies must need to disclose in their final annual report and 10-Ks all share-based payments, what type of stock options they are giving, and how the stock compensations are calculated and how it will impact on income statement. Because if you look at the compensation expense due to all stock related incentives, the expense is huge. And you have seen one example earlier here in the slides that sometimes this stock compensation expense could be 40% of the total revenue of the firm. So in one sense, it is very expensive since GAAP requires these disclosures and recording of these stock compensations so that companies can use these options very carefully. Now, here companies also need to disclose how they measure the value of those stocks or the stock options. That means all their compensation expense. And of course, they will also show how that will affect on their cash flows, whether cash flows is increasing or cash flow will be decreasing due to those stock option exercise or all other stock related incentives. Now, here we will see one comprehensive examples. One company is giving three types of stock related compensations. Number one is restricted stock awards. This is real stocks they are giving on the grant day, which is 100,000 restricted stock awards, and the grant date is January 1st, 2025. And here, the employees cannot sell these stocks during the service or vesting period, which is 4 years. If they leave the company, these restricted stock awards will be forfeited. This is one compensation plan. Another compensation plan is stock options. So the company is giving the stock options, and employees can purchase stocks at $13. This is the exercise price, but they cannot exercise it in next 4 years. That means the service period is 4 years, and they also determine by using Black-Scholes stock option valuation model that each option price is $2. The third stock compensation plan is restricted stock units. It's also stocks, not options, but slightly different than stock awards, that the stocks are not issued or transferred on the grant day. Rather, it will be transferred at the end of the service years. So the condition is that here, under the third plan, 120,000 restricted stock units, vesting period is little longer, it's 5 years. And again, if employees fails to stay with the company for 5 years, these stock units will be forfeited. And you have little more information. PR per value of each stock is $1. And when they are giving these granting all these stock options at the beginning of 2025, share price here is $12, and end of the year share price is $8. Now we need to do some journal entries based on all three stock compensation plans. So first, we will do journal entries on the grant day, which is January 1st, 2025. We will also prepare journal entries end of the first year. Now you have two more requirements. One is for the stock options. We are assuming that at the end of 4 years, the employees will exercise the stock options. That means at the end of the vesting period, all options will be exercised. We'll do the journal entries. Another journal entry we have to do that after 2 years or after 1 year, the employees actually who is receiving these restricted stock units resigns. That means you have to record the forfeitures of the restricted stock units. So let's do the journal entry on January 1st when all these three stock plans are granted. So here, only for the restricted stock awards on the grant day, when we issue the actual stocks and transfer it to the employees, we will record a journal entry. And that's what we did under plan number 1. So we issued the stocks $1 and we have $12, the remaining $11 paid in capital in excess or additional paid in capital. And on the debit side, we record unearned compensation. It's kind of a deferred compensation. On the other hand, for stock options and restricted stock units, on the grant day, we do not do any journal entries, and that's what we did. Then what we do here over the service period, based on the value or the value of the stock options or the compensation expense, we will allocate it over the service periods. For our first compensation plan, which is restricted stock awards, and our service year is 4, and we split it by 4, and each year, end of each year, we'll record 1 year's compensation expense, which is $300,000. Since we showed at the beginning as a unearned compensation, so we'll reduce it by for 1 year's or $300,000. Now for here stock options, 1 year passed, employees actually worked for the company, so we have to record compensation expense for 1 year. And we know for stock options, each stock option price is $2, and total number of options were granted 1 million. We multiplied it and divided it by 4. So for the first year, we are recognizing 1 year's stock option value or compensation expense, which is $500, and we are also showing it as part of our equity paid in capital, but we label it as a stock option. We do the similar treatment for restricted stock units. We recorded the compensation expense. The only difference is that when we calculate the value, we use the stock price on the grant day, and here the service year is 5 years, so we allocated over the 5 years period, so we divide it by 5, and we recognize the compensation expense, and we credited paid in capital and labeled it as restricted stock units. Now for the requirement 3, we assume that all stock options are exercised. So here we will do the journal entry. First of all stock options are exercised. If you go back, the stock option condition was that employees will be able to purchase those stock for $13 per share, and that's what they did, and we assume that they exercise all stock options. So here we will actually record cash debit, and we will multiply it by $13 each share and 1 million shares, and then we will record the share issuance $1 per share, and the difference will be recorded as paid in capital in excess of par. And you remember at the beginning here we actually recorded every year as here paid in capital stock option, we credited it. Now since the service period is over, vesting is done, and then the employees are exercising all stock options, we have to remove it from our paid in capital. So we are debiting our paid in capital. Sorry, there is a typo. This date will be at the end of 2029, not 2025. Now requirement D had that here the employee left, and how we will record it. So here what we will do, we will check how many months or years of that employee's service year passed, and how much we recorded as a compensation expense, and of course it's restricted stock units. So since it's forfeited now, we will eliminate those compensation expense, and the part we also recorded as paid in capital restricted stock units. So we just reverse the journal entry to eliminate those from the restricted stock units. Now we will see another type of example. Here, companies can also give stock appreciation rights. So for these type of compensation plans, the employees are not receiving stocks, neither they are receiving any options to purchase the stocks. Rather, they are receiving some share price appreciation related gains. That means the condition is that if share price goes up after a certain price, then the employees will receiving the incremental share price changes, and that will be for certain number of shares, and we will see whether employees are receiving those in cash, shares, or combination of both. So employees might have options to get those incremental share price changes or share price appreciations either in cash or in shares or combinations. Now here we will see how we will record it. So one condition we will learn, if those share appreciation employees receive in cash, we will record it as a liabilities. If they receive in share forms, then we will record it as equity. So one example. Now here we will see the example that the company is giving those share-based equity awards, or in short we also call them SARs, and employees are receiving in cash. So we will record it as a liabilities. And here we will also see that how share price is changing every years, because employee will have, of course, a certain number of years they cannot get this award or service period. So what we will do at the end of every year, we will look at the share price appreciations and we will see how many years passed, and based on that we'll accrue our compensation expense. So let's see one example. Here the condition is that the employees will receive those share price appreciation as cash payment or SARs, so we will record it as a liability. So again, at the end of every year, we'll look at the current stock price in the market, we'll check the appreciation part, and we'll check how many years passed, and based on that we will record our compensation expense. And once the service period is over, then we will eliminate those and we will pay the employees that stock price appreciation based on our yearly adjusted compensation expense numbers. So let's see one example. Augusta Hotels, they establishes a stock appreciation right plan on January 1st, 2025. And the condition is that we will follow one pre-established price, which is $10, and it's for 10,000 shares or SARs, and we will see how much share price increase, share price appreciation happen, and based on that, employees will receive the incremental price in cash, and the service period is 2 years. So here we'll see what happened at the end of the first year. The price increment here $3, and we'll check what happened, and then at the end of 2026 or the second year, the price appreciation or increment here $7. But we'll see a little more conditions that the employees are not exercising at the end of the second year when their service period ends. Rather, employees are exercising that SARs at the end of the 3 year. So what we will do, an additional task, we will again adjust that compensation expense based on the share market price at the end of the third year, and then we will give it to the employee. So now here we'll see the table. At the end of the first year, fair value increment or the value of that SARs $3. So 10,000 SARs, so total amount is $30,000. Remember, the service period was 2 years. So at the end of first year of 2025, we have to show 50% accrued compensation expense. So $30,000 total value of the SARS, and we'll accrue half of it at the end of the first year. So 2025 compensation expense will be $15,000. Now, one condition for this type of plan is that at the end of the year, we will look at the share price and we will remeasure the value and we will adjust the compensation expense accordingly. So at the end of the year, the fair value of the SARS for each share is $7. That means compared to the predetermined $10 price, perhaps the stock price in the market went up to $17. So for each share, the value is 7, and 10,000 shares we multiplied by 7, 10,000, 70,000. Now 2-year service period passed, so we will accrue 100%, right? So at the end of the second year, the employee is supposed to get $7 because of each share price appreciation. So the employee should receive $70,000 at the end of the second year. Now remember, at the end of first year, we recorded compensation expense $15,000. So at the end of the second year, we will record the remainder, that means 70,000 minus 15,000, which is 55,000 as compensation expense. This is one different criteria that we adjust it at the end of every year based on the stock market appreciation for SARS. Now, what will happen at the end of the third year? The employees are exercising that. So at the end of the third year, we see that the value of that SARS is now $5. So 10,000 SARS. So if we multiply, then of course we have to show the all accrued values for compensation because service years is done. So for $5 each SARS multiplied by 10,000, you will have total value 50,000. That means if employee wants to get it, that employee is supposed to receive 50,000 as compensation expense. Now look at that. After recording the compensation expense for last 2 years, currently our compensation expense is shown as 70,000, but at the end of the third year, the employee should get based on the market price end of the third year, which is supposed to be 50,000. So that means based on past 2 years compensation expense recognition, it's overstated by 20,000. So what we'll do, we actually will do a reverse entry. We will reduce our compensation expense by 20,000 before we record the allocation or the payment of the SARS. So let's see how the journal entries will look like. So here the journal entry, you will see here at the end of first year, we calculated our compensation expense based on the value. And remember, it's only the first year, total service year 2. So we will do half of it, which is 50% of $30,000. And since employee will be receiving cash, we record it as liabilities. If they would receive stocks, we will record it as paid in capital. So now here we are recording as liabilities for the first year's compensation expense 15,000. Second year, when the vesting is done or the service year 2 years are finished, so we have to show both 2 years or 100% compensation expense, and that was 70,000. But remember, last year we recorded compensation expense 15,000, so we will record the remainder as the compensation expense at the end of the second year of 2026. Now the employee actually receives or exercise that rights at the end of the third year, and based on that, the compensation expense should be $50,000 because the value for each SAR is $5 and multiplied by 10,000. So here, based on last 2 years, our compensation expense was 70,000. So what we are doing first, we are reducing it by 20,000. So after doing all these three journal entries, your compensation expense and the liability balances will be what? 50,000, which reflects the current market price when the employee is exercising that right. So when the employee will receive that that SAR amount, they will receive based on that day's stock price, which is $50,000. So they'll receive cash 50,000, and we also know that by that time at the end of the 3 years, the liability balance was also 50,000. After doing early adjustments, we will eliminate or remove the liability. So far you learned different type of compensation plans and how we record those and how those will impact on our financial statements, especially calculation of the compensation expense and the impact in the equity part, and the last example, how it can also impact in the liability parts.